ladies and gentlemen. Welcome aboard the Pilot Money Guys podcast, where our mission is to help clients build and protect wealth to achieve their dreams and goals. This podcast is brought to you by Leading Edge Financial Planning. Without further ado, here is your host, Robert Eklund.
All right. Welcome to the Pilot Money Guys, episode 78, flight 78. Today, it's we do not have Rob, the rubber mallet, but he'll be back next time. Today's his birthday. So we've got John Creme de la Creme Kramer in this place. Did I say that right, John? That's hard to say.
You got it. You got it. Those are large shoes to fill. So
that's right.
I'll do my best here, Charlie.
Yeah. So we're glad to have you today. And, we're going to talk about a bunch of stuff today. The meat of the mission today we're going to talk about is, should you hire a financial planner? Should you hire one? And if you choose to do that, how do you evaluate or interview a financial advisor? We'll talk about all the different questions you might want to ask and then go from there. We're also going to hit some airline news. What the heck is going on at FedEx? And we've got some good knowledge on that. And then I'm going to address a question, John, that we get a lot, and that is, how do we invest in artificial intelligence? How do we invest in AI? Should we invest in AI? So we're going to go through those today. But first, let's talk about FedEx. What is going on there? They've been in the news. I was at a conference last week. I was at the Women's Aviation Conference in Orlando last week. Aerocrew News, our friends over at Aerocrew News, put out an article and said, hey, FedEx is cutting back, although there's no mention of furloughs or anything like that. But what do you think? Anything you got for us today?
Yeah, I think this is a question that everyone's asking me. When people talk about companies downsizing and people are getting laid off, like everybody's ears perk up, and we throw out the F word in aviation as furlough. So that's the one you don't talk about. But there's no real talks of that right now. Like, no one's really speculating that they're going to furlough pilots. I think we're just in a market with freight where FedEx tends to be this like leading indicator for the economy. So when there is a looming downturn on the horizon, FedEx tends to feel that before the actual market or the economy does. So when post-COVID, we saw a lot of international freight was down. Numbers for total freight was down. But I think what you're seeing in the latest news is really just a construct of the company. FedEx announced, I think two quarterly earnings ago, they announced this push for Drive. They call it's an acronym that basically the company is going to focus more on the most revenue generating and the cost effective ways to deliver packages. So where it makes sense for a package to be driven, it can be driven at a fraction of the cost instead of getting it flown. So some of the maybe smaller rural communities that we fly into, smaller airports, you may see those getting consolidated on one airplane and then, trucked to its final destination. So the big one in the news was really the drop yesterday. The Postal Service and FedEx did not reach an agreement, and we've been hauling Postal Service freight for a long time, probably over 2 decades. But they have essentially moved all of the Postal Service contract to UPS. So when people look at these two companies, I try to differentiate between UPS and FedEx. People will only really know, like, I get a FedEx package and I get a UPS package that shows up on my doorstep, but they're two very different companies with the same kind of mission. And so FedEx was created as an airline. It was overnight U.S. mail was how FedEx got started. And so FedEx is more of the airline that has trucks, where UPS started as parcel service for just the local area and grew. And so UPS is more a trucking company that has airplanes, and where FedEx is a airline that has trucks. So I think it's just a push for FedEx to have this, more revenue generating overnight freight, and cutting back in the areas where it's cost effective for a company. So I'm not hearing any hearing any F words on the front. So we're not too scared as pilots at FedEx right now, but it's definitely some changes going on at the company. So it'll be interesting to see just kind of how it shakes out, honestly.
Yeah. And it's always difficult when your airline's not growing. That's even though I know that our FedEx pilots, we hope there's not the F word, not the furlough word they're introduced, but it's still challenging, I know, to have these kind of restructurings going on. But how does Amazon play into this? That's a question we get a lot too. Does Amazon impact any of this at all?
Yeah, I think that Amazon is its own entity, and they have really captured the 2-day delivery. Everybody got very used to getting a package within 2 days. So it's kind of changed the outlook for package delivery service in general, where everyone is just trying to keep up with getting overnight packages delivered. So I think that it'll be interesting to see like what pieces of the market that Amazon takes on. I don't know all the details about their shipping, but it seems like they are very focused on putting distribution centers all across, so they're never more than an arm's length away from anybody that is an Amazon member that gets 2-day delivery. So they do contract a lot of their air freight. So they use Atlas Air, they use other cargo shipping companies. They have contracts with UPS. So I would not be surprised if FedEx ends up with some Amazon packages on our airplanes. But I think all that is kind of yet to be determined. So they're definitely, obviously, a big player in the package delivery. But I don't think Amazon owns any airplanes. So if you see an Amazon painted Prime Air airplane, it's probably owned by another company and then leased back for the delivery service. Yeah.
I've seen a few of those, and I've seen a few of those in Tampa. Probably other places too, but nonetheless, for whatever reason down there. But I think what you said was interesting about the FedEx and the freight delivery of the world, cargo in general, being kind of a leading indicator. And I remember when I was doing my MBA and in the financial planning space, I did this study on the Baltic Sea Index. And it was about how the shipping in the Baltic Sea on these big shipping containers, whether they could predict or had any predictive power at all as a leading indicator. And it's similar with the cargo world and at FedEx and UPS and others as well. But the thing that I think is a little different this time is COVID. It created such a whipsaw because FedEx, UPS, they were crazy busy during COVID. And I remember just the backlog of shipping and all that stuff. And then it smoothed out as like this whipsaw. And then, it went down and went back up again. It seemed totally out of sync with the passenger side. And I remember a buddy of mine at UPS last year was like, we are headed for an absolute recession. There's no way around it, and I was like, what are you talking about? But it was, normally that might be the case. And it might be this time. We don't know. But it is interesting how that the cargo space in general has been whipsawed since COVID. It's been fascinating. So
yeah, you saw a lot of I think FedEx and UPS both were kind of in this lull of freight hauling business right before COVID kicked off, and then it opened this huge opportunity to pick up extra freight because all of the ports were just packed full. Mm-hmm. I mean, I think that I remember doing some flying during COVID, and you go into Hong Kong, and the port was just, there were hundreds of ships just waiting for weeks to to offload their freight into the port. So companies were looking for ways to get, their raw materials during COVID. And the only way that they could do it was pay, quadruple or 5 times the price and get it on an airplane. So we fell into a good situation as far as revenue generation goes during COVID, because everybody needed to get their goods, but all the ports were jammed up. You heard that everyone was talking about, global supply chain. That was like the no one really digs into supply chain until it fails.
Yeah,
right.
It was cool to be a logistician. I think that's how you say that. For the first time, I was like, oh, you're in logistics? Oh, that's cool. Because the world was changed for COVID. But it's amazing the impact of that as we look back. But hopefully things settle out and smooth. And it seems like FedEx might be just taking a reset. But that's fascinating. And hopefully things get turned around there sooner than later. But
yeah, I think it's all just business cycles. So
yes.
I'm kind of an optimist. I know
right.
There's probably several different views of all the happenings that are going on with the company, but I'm pretty optimistic about it. I think that a company that is changing is a good thing in my opinion, because the world changes very quickly. So
maybe some growing
we'll see how it all plays out.
Yeah, absolutely. Well, awesome. One of the other things we get today is questions from the flight deck. One of the questions we get a lot lately is, how do we invest in artificial intelligence? AI is the biggest, seems like one of the biggest booms we've had since the .com, and it's pretty fascinating. In fact, some of the software we use to edit this podcast has AI in it. Some of the meetings that we're in, I don't know if you know this or not yet, John, but we have an AI presence in some of our meetings that takes notes for us, which is really creepy. But anyway, it's kind of going to be, that's what it's going to look like. I think it's going to be interwoven into all different facets. And it's the same with companies and how we invest. What is an AI company? So we'll get to that in a second, but let me try to answer this question. First of all, investing in AI is not any different than investing in any other specific sector. Like, hey, do I want to invest in energy, real estate, consumer staples, healthcare? So we think of AI in the same way. And in fact, maybe AI right now is doing really well, but maybe it's more of a tech thing. It's kind of hard to differentiate. So first of all, to answer the question, it's a speculative, investment. And so what that means is you're kind of taking a chance, on AI and which player in AI is going to win. It was like the .com bubble. A lot of those companies didn't make it through the .com, but a lot of them did. You just didn't know which ones at the time were going to or which ones weren't. What do you think, John? I mean, anything come to mind there?
No, I actually see a lot of these pop up just in the news and on the social media feeds. Everyone's saying, what's the next NVIDIA? What's the next small AI company that I should be investing in now? But I think my philosophy on it is hesitant because I think, number one, it's real hard. Like you said, it's real hard to pick the winner and who's going to be the big player in the scene. And then, picking one or two small AI companies seems like it seems like a tough chance. Like in the stock market, everything responds so quickly. Like by the time you're hearing about a company in your workplace or through your social media feeds, like in my opinion, it's already overvalued. It's already reacted to the changes. So, I think AI obviously is not going away. Like it's gonna come in and play in the business and the world, and probably in just like daily use for most people. AI is going to be a part of what you use daily, whether you know it or not.
Yeah.
So picking the right stock or the right company that's going to hit it big, I think is it feeds off of this behavioral aspect of just like, hey, I'm going to pick the big winner, the big payout. But I think the likelihood of that is probably pretty slim because there's just so much out there, and the market reacts so quickly to what news gets put out.
Yeah, I think you're right on. And I think if somebody's going to do it, use an ETF. There are lots of ETFs out there. That way you're at least a little more, if your guess doesn't pan out, you don't lose everything probably. But an ETF, I kind of just did a quick Google search, John. I was like, all right, give me some best AI funds, and anybody can go do that. So a couple of them popped up. Of course, the names here are important. And that's funny because in the late 90s, if your name included .com, pets.com, your stock immediately went up, regardless of what it was. So these names that I Googled, in fact, again, just did a top 10, whatever, but BOTZ is one of them, BOTZ. That's the Global X Robotics and Artificial Intelligence. Then there's iGPT. That has a ring of the Chat GPT, right? So that's an Invesco AI and next gen software ETF. And there's Chat. And so the interesting thing is I Googled a couple of these and then we put them in our software. And so let's just take iGPT, for example. That's an Invesco AI, and it's done pretty well the year to date, even pretty good the last 1 year or 12 months look back. But the last 3 years, it's annualized a negative 2.5%, a little over that. So, it's not a no brainer, just to go, hey, I'm going to pick AI and I'm going to invest in it and I'm going to do great because it's going well for AI right now, seemingly. The last thing I'll say here is that when you look into this ETF and you're picking an AI ETF, right? It says it in the title, AI and next gen, whatever. The top holdings are, guess what? NVIDIA, Facebook, Google, Adobe, Qualcomm. I mean, so it's like, well, is that AI? There's Intel, Micron, and of course those are chip makers. So is it, you got to really know what you're investing in, then take a look at it. Think about, again, it's a speculative bet. So it's not a no brainer. My thoughts and what I tell people is like, hey, you own a lot of AI influenced companies, even if they're chip makers or Microsoft, it's interwoven in those companies like we talked about. And you own those if you own US stocks, in an index or mutual fund.
Yeah, it sounds a lot like that sounds like the S&P 500 right there. So
yes, exactly.
When you're already invested in large cap U.S. equities, then you probably have a lot of those companies anyway. So the S&P right now is so tech heavy that you're seeing you're probably already invested in a lot of these companies that are putting a lot of money forward into AI. So
absolutely,
again, it's I think this like fear of missing out. People are afraid they're going to miss the next best thing, or they're not going to be, and that it just goes back to like your basic investing principles, right? Yep. So just being diversified and having your investments spread over all the different sectors help capture those gains when the market really does go off in certain areas.
Yeah, you nailed it. And a lot of times, go back and check out our podcast flight number 30. We talk about this and when ARK ETF back in the day was phenomenal, right? And so people were jumping all over that bandwagon, but unfortunately, nobody bought ARK until the price was already way high, because otherwise you had no indication you should buy ARK until the price went up, and then you bought it and you bought high, and then when it went down, you sold it. So that's exactly what happened. You can kind of trace the behavior, and that's the difficulty of these types of bets that we make. Is like there's no indication of success except the price going up, and then it's like you said, too late. So anyway, go do it, but use some discretion and don't invest a bunch of money you can't afford to lose. Right? That's what we always say. And we're boring. I like it. That's such boring advice, isn't it?
Well, boring, but maybe best for the long term. But right. Everyone has to make their own investment mistakes at some point. Yeah. So
yeah, absolutely. All right, it's time to get into the meat of the mission, John. And we brought you on board today because you are a guy, before you became an advisor, you hired an advisor and went through this process yourself. So today we're going to talk about this in two phases. First of all, should we do this? Is it something, who should consider hiring an advisor? And then we'll kind of go into a few points about how do you do that? What are the questions that you ask? And so we know, and I don't know about you, John, but what made me think about this topic was all these new airline contracts have come along. And so a lot of people have gotten into the point in their career where they say all of a sudden, like, hey, I got this new contract. It's more money than we've ever made. My 401k balance is becoming larger than I've ever thought it would be, becoming a bigger responsibility, like flying a larger airplane or whatever. But maybe we should have someone on our team. And let me preface our discussion. Our discussion is that when we talk about the advantages of having an advisor, we're talking about someone that is competent, trustworthy, and we'll talk about how to find that person. So unfortunately, in the financial services world, there are some that are not competent. There are some that are not trustworthy. So it's definitely takes, if you're looking out there, you need to do your due diligence. But John, what do you got?
Yeah, I would say that I've gone through several stages of like, do I need an advisor? And when I, went to college and I was young, didn't have a lot of money. I was saving a little bit of money. And at that stage in my life, I was very convinced that I could do this myself. I'm interested in it. I'm passionate about finance. Like this is something that I can just do on my own. And that has kind of like ebbed and flowed over the course of my life of whether I need an advisor or not. But I've definitely gone through those different stages and different mentality about it. So I would say at a very young age, I would say the benefits of having an advisor, they're going to go through life stages with you, So I think that the for a young person that says, hey, my situation is not very complicated, I don't need an advisor. I think that's kind of a tough, that's not really the right way to think about it, because you have all this time. So maybe the mistakes that you make with finances in your 20s, that can change your net worth 40 years down the road. You're just doing something that, you think is this all truth about money. So, and then I went through kind of a stage where the more I learned about it, the more I thought, maybe I do need an advisor, just as even if they don't have to be smarter than me, or they don't have to know more things about the financial world than me. It just, I use a financial advisor today as really a sounding board. Does this make sense for me? Am I making a mistake here? And those kind of peace of mind discussions that I have with advisors is really worth all of it to me. So, I mean, I thought it was all about, in the very beginning, I thought it was all about market returns, and I was like, oh, how do I get the highest market returns? How do I get the smallest fee? And now I would say, like, as my financial life has changed and become more complex, I think there's a big aspect of just not making big mistakes, so that's kind of how it's ebbed and flowed over my life. But obviously, the more money you have, the more complicated your situation. Now I'm married. I have 3 kids. Life gets more complicated, and you start talking about legacy and estate planning and all of that. There's a lot to it. So I've definitely changed my mind since my initial 20-year-old self said, no, I can do it myself.
Right. Yeah, absolutely. And, it reminds me too, like you were talking about, your situation reminded me of ours, and that, since we're in the business and we have a lot of our advisor training and our meetings, we get to talk about these concepts all the time. And the more I learn, and we study it again all the time, almost daily, as far as some of these concepts, the more I realize, the more I know that I don't know. You know what I mean? And so that to me guides my decision making for my personal finances. Like, hey, I have to prepare and do things, and I don't know the future. I don't know the outcomes. In other words, I've gained a humility to go, hey, we have to invest with imperfect information. Again, we don't know the future. So I think maybe that's kind of where my journey as well. But also I like having for my family, like if something happened to me, I know that my wife, Lisa, and our kids would have a team surrounding them immediately. And that's our leading edge team there. So that's a perk for us, you and I being in the business, to know that our families will be taken care of if something happened to us. And I know that a lot of our pilots will say that, even, it may not be the only reason they're looking to hire someone, but it's a big deal. Because, hey, if something happens to you out flying around or whatever, and they want their families to be taken care of, that's a big deal. So.
Yeah, no doubt. Yeah. Having that, hey, when something happens, or if you have a question, call Charlie.
Yeah.
So that's a big, peace of mind thing for somebody, especially with a family, a wife, kids, grandkids, even. That's a big deal.
Yeah, absolutely. So number one, on our list that we tried to put together here. So what's it worth to you is kind of the first thing. In other words, to some people, it's just not that valuable, and you and I will today attempt to put a number on some of these services, a number value. That's really hard to do. But when we meet with potential clients, we talk about all the services we provide. And this is what you should do as a consumer if you're looking for an advisor. What are your services? And we talk about that. But at the end of that discussion, I I usually will ask, is it worth it to you to have someone on your team to help you make great decisions? Someone that you got to trust this person. You kind of got to like them too. You don't want to work with someone you don't like, quite frankly. But sometimes people go, no, it's not worth it. I think I'm not worried about my finances. I'm not stressed out. We do fine and it's not worth it. So that's, I think that's the first decision. And sometimes people go, yes, it's absolutely worth it. But that to me goes in the category of, John, I don't drive a car that costs $80,000 either. To me, it's not worth it. I'll take a $20,000, $30,000 car any day and it makes me happy. The $80,000 car does not make me happy. You know what I mean? So everybody's a little different in those areas.
Yeah. Finding somebody that has a complementary personality is pretty big. So when we have prospect meetings, I think that's a lot of it. It's personality type. Like where do you see your financial advisor's role in your life? Is it somebody that takes control of everything and you just go off and look at it once a year? Or is it somebody that jumps in and helps guide you and just gives you little pieces of advice here that benefit you in the long term? So I think it's like, do I need an advisor? It's just such a personal question.
It is. Yeah. Well, let's take a minute here to try to, the number 2 bullet point here, if we do our little 3-point sermon, by the way, is that, how might an advisor add value? There's a lot of different ways. One of the things to me that I enjoy the most, and I'm not sure every advisor does this, but I think it's all about helping someone achieve their goals, with the financial aspects of that. And sometimes we get to help people articulate those goals and clarify that, so I think that's a big value add if somebody is interested in that an advisor could do for them, depending on, again, their services and whatnot. But that to me, I think is a really fulfilling part of our job, is to go, hey, what's important to you? What are you trying to achieve? And let's try to make that happen. Of course, we get to affect the financial side possibly, but what do you think, John?
Yeah, I think that, I see this as inflation has changed a lot about what we would call is, am I achieving my goals for retirement? My parents would always say that, hey, what you have to do, you have to save money until you hit $1 million. If you have $1 million, then you can live in perpetuity and all is good. And it used to be that way. I think that was like a big push. They taught people, hey, if you have $1 million in your retirement savings, then you'll be set for life. Well, now it's not so much a round number anymore, but there is maybe this idea that there's this retirement number that's out there, that as long as you hit that number, then you're good. And what I found just being a financial advisor is like, it really all depends on the kind of lifestyle you want to live. So I think an advisor's role and where they add that value is just kind of creating concrete aspects to what retirement looks like. Like a lot of times we'll run our Money Guide Pro situations up for prospects or for our clients. And I've had several people say, hey, this is the first time I've really done this, like putting concrete things. Hey, I'm going to vacation once a year. I'm going to buy a car every 5 years. And it's putting concrete value to what retirement looks like for them, to be able to say like, hey, I think at the end of the day, most people just want to know, like, am I on track? Like, am I doing the right thing? So that's definitely a big plus side for advisors. Most people probably haven't gone through the numbers or looked at that.
Yep. I think you nailed it. That's in our surveys, that's one of the most, discussed questions. Like, I want to know, am I on track? And then, a lot of, we evaluate that. An advisor should evaluate those scenarios for someone, and not just pay lip service to it. A lot of people go, oh, you're going to be fine, and hey, let's run a little calculator. You're going to be fine. And that's not enough. There's a lot more nuance to it. To me, I think there's a lot more to learn. And then we get to follow on with that question, John, of, hey, looks like you're going to be on track. Maybe we need to do a couple things a little differently or a little better or whatever. Heck, maybe you're saving too much. Hey, go spend more now, enjoy life more now. What's that balance? And that's the more nuanced part I was talking about. But what I also love to do is I love then to go, okay, you're on track and you're on track for what you want. Now, what's going to derail you? And let's attack that as well. And for pilots, it's a lot of things like disability, events in your life, a death, God forbid, something like that. But those things, a bad market, is a bad stock market going to derail you, and what does that look like? So we like to run that like a simulator and fail a couple engines and do some V1 cuts with your financial life anyway, I'm going to say. So.
Yeah, I think that when you're young, there's always this mindset that, stay aggressive, hit those market returns. And when I talk to young prospects or clients, they'll say that's usually their biggest concern is, hey, my returns weren't as good as they should be. If they're coming to me for help, they're looking at returns. And then as they get older and they accumulate more wealth, it tends to be those kinds of questions. It's like this loss aversion. Once I've accumulated a decent amount of net worth, then the question is, how do I avoid the big losses?
Yeah.
So it's this mind shift over, it's insidious. It happens over years and years and years, but the focus tends to be more on that. So I think that's why, you have a little bit more conservative nature for the as you approach retirement, your mindset just gets a little bit more conservative. But I think that's probably the biggest risk of doing your finances on your own is making one or two very costly mistakes.
You're right. That's a great point. And it's funny how you and I've been talking here for a few minutes on this about how do advisors add value. We're trying to be objective and talk not just about ourselves, but we haven't mentioned investment returns, and I think what I put down though under this list was risk, because it's not like you just said, it's not so much about, hey, just get me the highest return possible. Well, okay, well, let's go invest in Amazon, I guess, or in Nvidia, but then you better be ready for some serious potential loss. But the point is there that I'm trying to make is that it's really about having the appropriate risk. Are you taking the right amount of risk? I talked to a gentleman the other day and he said, hey, so-and-so, I'm getting ready to retire in a few years and somebody recommend that I be 60% bonds. And I was like, whoa, are you sure that's the right, it sounded kind of a little lopsided to me. Now there may be some other circumstances I don't know about, but that's a big deal. And that's why I think these newsletters, I don't want to go off the rails on a newsletter, but they don't address the risk tolerance at all. And that is super important. In fact, target dates don't fully address it. We don't want to go down that path either. But the point is, investments, we can't control short-term returns and short-term volatility, but we can make sure people are in the right risk bucket, for lack of a better term. And I think that is hugely impactful. And sometimes that can be all the difference in being successful or not.
Yeah, I think that's exactly on point with just analyzing your own personal risk. So I tell people, take as much risk as you can stomach in a downturn. Yeah. So we run those little, scenarios like you see if you take someone's total asset value and then you run a 2008 scenario against it and say, okay, hey, if your portfolio goes down this much, like, getting into the touchy-feely aspect of behavioral finance, it's like, how does that make you feel? Yeah. Like, are you going to do, if your investment would go down 35, 40%, what would you do? And so I think that changes a little bit of aspect. Definitely since I've been on at Leading Edge, I've come back to the bond idea, buying bonds and having a little bit more diversity in my portfolio, just because I don't really want to stomach some of those losses. I want to take advantage of it, but everybody wants a 15% annual return, but nobody, not everybody can stomach the 30% downturn either. Yeah. So.
Yep. You're right about that. That's great. We could go on, of course, about all those benefits because we're super biased here, and just make sure that when you interview, your advisor or your potential advisor, that you're talking about the things that are important to you. And just to summarize before we move on as to the how to do this, what to look for, Vanguard put out put out a paper called Vanguard's Advisors Alpha Strategy. And now they have a little bit of bias as well because they have advisors too. So they're very motivated to put out like, hey, how do advisors add value? But it's probably the most analytical, if that's the right way to say that, because the numbers here are hard to pin down. But they looked at a lot of things like asset allocation. That's what you and I kind of talked about, diversification, all the fundamentals of investing, right? So there's some value there. They actually said it's greater than zero, right? So yeah, greater than zero. And then they said there's cost-effective implementation. And that is, it looks like reducing the expense ratios, using ETFs maybe versus a high cost mutual fund. And that there's some value add there. Rebalancing, that's a big deal. There's two types of rebalancing. One's a risk, keeping the right risk bucket, like I just talked about. The other is maybe rebalancing within the stock portfolio, rebalance between large and small companies. And so there's some of that. The biggest one, though, that you've alluded to multiple times already, and that's the science of behavioral finance. And they call it behavioral coaching. To me, that one is about making solid, fundamental decisions, not based on emotions. And that is really, really hard to do. But what do you think, John? That's a big one for you, I know.
Yeah, I will. When somebody gets caught up in returns, they're more, they tend to go toward that top one you talked about, the suitable asset allocation and, how do I balance this risk versus return situation. They get very caught up in like, hey, my last year's statement, I was up 7%. And my friend over here at the water cooler was up 12. Like, what am I missing? So they get caught in that. But I would say the behavioral coaching is like, no matter what the market returns give you. And I mean, this isn't true if you're getting, 70, 80% returns because, you're buying NVIDIA or something.
Right.
But behavioral coaching is part of, hey, if I can get you to save just a little bit more, if I can bring your savings rate up 2 or 3%, none of that is going to matter.
Yeah.
Like if you're able to delay some of these things or make your monthly budget more effective, if I can get you and your spouse on the same page and in the same boat, rowing in the same direction, none of the returns can beat that kind of effect in a relationship. So that's really when I meet with people, we don't even have a investment discussion really until like the third time. It's a lot about goals. It's a lot about current lifestyle, and really just getting two people on the same page when it comes to where they're headed. Because if you can get two people going in the same direction and saving a decent amount of money or upping their current savings rate, then that's going to save you the most. And this chart says 0 to 200 basis points for behavioral coaching. So we made a joke just in the talking about this podcast before we did it. It's like, I think that behavioral coaching can be 500 basis points, just depending on how people are living, So I think that's a very American idea of, people are spending a lot of money. There's a lot of marketing out there that people want you to spend your money on. Yeah. And if we can get you focused in your personal lives, then you can beat any investment returns.
Yeah. You're right about that. If you invest a ton of money in a terrible investment, well, not too terrible, but a mediocre investment, you're probably going to be very successful still. But clearly that's not optimal. But to summarize the article that Vanguard put out, they said that based on our analysis, this is from the paper, advisors can potentially add up to or even exceed 3% in net returns by using the Vanguard Advisors Alpha framework. Well, what that means is you better be a trusted advisor. They better be competent. They better be qualified. We'll talk about those things in a minute. It says, because clients only get to keep, spend, or bequest net returns, the focus on wealth management should always be on maximizing net returns. In other words, thinking about the tax implications in there, right? We do not believe this potential 3% improvement can be expected annually. Rather, it is likely to be very irregular. Further, the extent of the value will vary based on each client's unique circumstances and the way the assets are managed. So anyway, a lot of disclaiming going on there, but it is interesting how the value can be lumpy, because you nailed it earlier. hey, you might be just trucking along just fine, and all of a sudden a year comes along like 2020 where it's very, very scary. You make a bad decision, and now it's going to take a while to recover potentially, so that's that is an issue. But the last thing I don't want to kind of glossed over how they got to the 3%, but the other value came from helping people with spending strategies, a withdrawal order, and that's in retirement. And that's one of the most valuable, other than the behavioral coaching piece, the spending strategies. To me, that's really complex, John. And that's one we study a lot as well. Is like, how do we spend money in retirement? What's the most tax efficient way to do that? And how much can you spend? That's a huge deal. So that was a big value add there.
Yeah, I think that's a big brain shift for people approaching retirement. Is your whole life you put money into your 401k, to your IRAs, and you're trying to get these returns to make the most amount of money. So you have this, invisible number at the end of your working days. Well, then nobody talks to you about the withdrawal method. And they say, okay, now once I hit age 55, 60, 65, now I'm retired. And then they don't have a plan for how to withdraw that money effectively, because all those monies are tied up in different assets, whether it's Roth money or pre-tax money. Maybe you have a pension fund, those types of things. That how you withdraw that money each and every year is going to affect your tax rate. It's going to affect when you start taking required minimum distributions. So it does get very complex in retirement, and spending strategy there, it says 0 to 120 basis points. I'd say that's pretty accurate.
Yeah, absolutely. And it's interesting because in our firm we have people with certified financial planner. There's a few of us that have that. There's a chartered financial analyst, and then Kevin and Jason went out a year or so ago and got the RICP. And maybe you can remember what that stands for. I can't remember right now, but it basically is retirement income. They took there's a whole certification, a whole study, books written on how to do exactly what you said. How do we shift from this accumulation phase to the decumulation of or spending in retirement? It's a scary transition for retired pilots and retirees in general. We know that from experience. But
definitely.
All right, John, we got a few minutes, man. We've gotten some good information so far. Part 2 of this deal. So let's say somebody says, yes, I want to hire an advisor. How do we do that? What are some things you think of? We've got our standard, again, bullet points here, but what do you think? How to do this? What's the first steps?
Well, I think the first step is really look at credentials, right? I want to know like what it took for you to become a financial planner. So the gold standard as your certified financial planner, that is a huge course. So just some background information on what it took to pass that test and how much you had to study for that, what kind of courses you took in order to become a certified financial planner. And then for me, on the Series 65 of financial planner, I had to take a test. I studied for several months, and I try to even break it down and probably give them too much detail, but why that's important and going into like fiduciary duties. So credentials, and then are you a fiduciary? Yeah. And the fiduciary is just the legal implications of me having to act in the benefit of the client. Yeah. So I have to make financial decisions for my clients that benefit them, and that's the structure of our business.
Yeah. And it's funny to say that because people are like, well, what other standard is there? That sounds like that's the way it's supposed to be. And it is. We agree with you. That's why we set up our business to be that way. Unfortunately, it's not. The financial services, I mentioned this earlier, in the US are a little bit confusing at times. You don't have to be a fiduciary. You can have a different standard that's called suitability. That comes from a long time ago where people were just selling stocks. You didn't have to be a fiduciary to help somebody trade stocks. That's kind of gone by the wayside. There's not a lot of strictly brokers out there anymore. So people are kind of leaning more towards the financial, but it is good to have a fiduciary. What that means is, in reality, or where the rubber meets the road, is you and I, John, and Leading Edge as a firm, we are held to that standard by the SEC. So when they come knocking, and they audit us, they're going to go, okay, you're a fiduciary. So here is your standard. And so we have to, operate to that standard on a daily basis. And there are different things we have to do. I would say from the client perspective, where the rubber meets the road is, how does their advisor get paid? Because really, in the eyes of the SEC, they are trying to protect the consumer, and they want to limit the conflict of interest from their advisor. So in other words, you and I can provide life insurance to our clients if they need it, but we don't get paid any different from that. We actually have some back office life insurance specialists that help us, but we do not receive a commission, because then I would be motivated to sell someone life insurance, right? If that were our, that's the idea behind the fiduciary standard, and there's always conflict of interest in every transaction, in business at times, but the idea as a fiduciary is that you limit those as much as humanly possible, in your interaction with clients.
Yeah, I'd say that's the first question when somebody is coming on as a prospect. Mm-hmm. Even if they don't choose us, I typically will follow up and say, hey, if this isn't a fit for you and you do still need a financial advisor, like, ask the first question, are you a fiduciary? And that really the fiduciary duty goes hand in hand with, just like you said, the conflict of interest and how do you get paid?
Yeah.
So don't be afraid to ask that question. If you're in a meeting with a financial advisor, they don't mind telling you how they get paid. And if they do mind telling you how they get paid, that's probably a red flag. Yeah.
Run away.
That transparency is part of that relationship too. Mm-hmm. So, just like you do in your meetings, and when I've sat into your prospect meetings, mm-hmm. that's usually one of the very first things we talk about mm-hmm. is, hey, this is the fee. Mm-hmm. And whether they're surprised by it or mm-hmm. In a good way or bad way, some people think, oh, that's cheap. And some people think, oh, that's crazy expensive. But at the end of the day, it has to be, you want that to be transparent.
Mm-hmm. Yeah, you're right. And as you're interviewing people, for our audience, if you're interviewing people and you're confused, that's a bad sign. You know what I mean? In other words, it should be clear, it should be simple. And if you are confused, ask follow-on questions. Don't be hesitant to do that. Because if the person cannot make it simple, clear, and plain, there's a problem. It should not be complicated. And if they tell you that you don't pay them, then you should also run away, because that means there's some backdoor fees going on. I flew with a guy one time, and he was telling me about his advisor. I was like, "Oh, that's awesome! Sounds like you had a good relationship. What's the fee? I'm just curious. I wasn't even in the business at the time. I don't think, John." He was like, "Oh, I don't have to pay him. I don't pay him at all." And I was like, "Wait a second. Does he work for free? I don't understand. Help me understand how this arrangement works." Well, he worked off of commission through the company, and it was like, so nobody works for free. But anyway, that's certainly something to understand clearly. So awesome. Let's see. We've got a couple of things on here. If people are looking, they can go to advisorinfo.sec.gov, and they can look up your name, John Creamer. They can look up my name, and even put our firm's name in there, and they can find out everything about us. One of the key documents, I think, John, and this is nitty gritty, but if you're going to hire an advisor, it's a big deal. Spend some time on this. Review a document called the ADV Part 2A. And if you go to advisorinfo.sec.gov, it'll be in the show notes. You can click on that link. You can put in leading edge financial planning. Actually, unfortunately, two of them will show up, but pick the one in Knoxville, Tennessee. You can see our ADV Part 2A, and you'll know everything about us. And that's the same with any of the firms that are registered with the SEC. So I think that's a big deal. You get to know fees. You get to read all the things. If they've ever been in trouble, or complained about, or with the SEC violations, it's going to be in there. So that's, I think, like you said before, disclosure and transparency, super important there as well.
Definitely. Yeah, definitely do your homework when it comes to that. It's just like a Google review for your financial advisor. So go in and making sure, people are saying good things about them, or, at least that, I mean, it's not going to have like actual reviews on there, but make sure that, there's no open complaints on the advisor you're trying to hire. That'd be a red flag in the beginning. But that's good info.
Yeah. In fact, John, you and I put in sec.gov, check your investment professional. You can Google that, and put it sec.gov, check your investment professional. Just type it in, it'll show up. But I typed our names in. I was like, John, our names are not showing up. Something's wrong here. Why our names should show up? I didn't know that was a website to go, hey, if your advisor has some kind of violation, then they would show up. So luckily we didn't show up.
So good thing we didn't show up. Yeah, that's good.
I know it. But anyway, if anybody has any questions, that's another resource. John, I'm going to hit a couple of these easy ones real quick, and then you can finish up with the one we talked about earlier with the values. But we talked about fees a little bit. What's an average fee schedule? The fee schedule we looked up was about 1% up to $1 million if somebody's doing assets under management, and then about dropped to 0.85% up to about $2 million, and then it dropped again. That's about an average fee schedule. You're gonna find a lot of people above that, and then like us, we're slightly below that. So, is that the best way to charge? That's another question. We could talk about flat fees, hourly fees, commission fees. There's all kinds. We don't have time in this podcast to cover all of that, but there's pros and cons to each one. But just understand that and make sure that it fits your needs. The other one there that you and I were talking about before is, what are you looking for? Are you looking for just investment management? But we believe that there's a lot more value in the tax planning, estate type planning, retirement planning, like we've always talked about. So a little bit more of a comprehensive approach. So what are you getting from your advisor or planner or whatever the heck they call themselves? Because there's a lot of different names as well on that. But understand the services that they offer. But John, the last one there, you can comment on those too. But the last one you talked about is kind of aligning values and stuff. But what are your comments and thoughts on those as well?
Yeah, I think that I always come back to the financial planning aspect, right? So what we do is a very comprehensive financial plan, and that fits all of our clients what they want, but it may not fit what everybody wants. So I've run into prospects before that have a very detailed approach to their own finances. And the value that I would bring to that scenario didn't make sense because they were doing all of the things that we're doing anyway. I think that it has to fit what you want out of a financial planner, because if you come to me and I'm offering estate planning and tax planning and financial planning, but you don't want any of that, then you're probably not getting what I'm getting compensated for. So do our values that our company has and our approach to investing match what yours is? Yeah. And we specialize obviously in airline pilots, high net worth clients, some of the doctors and, highly compensated folks, because with high compensation, because there's more of this planning that is involved. It's more complicated. So finding somebody that is, the clients that I get mostly are very much in the same life scenario that I'm in. They're airline pilots. They have young children. They're very busy. They don't have the white space in their life to sit down and do all of this, by themselves. Most people will come to me and say like, hey, I'm doing this with my wife, or I'm doing this all on my own. And it's really comes back to this, like getting a coach, we talked about the financial coaching aspect of it. But it's one of those things that I think our big value is in the financial planning, and just the fact that we're there to kind of coach you along the way, like bring you to the most optimal financial place in your life by giving you just little tidbits, right? Like if, it's like going to the gym. Yeah. If I go by myself and I have no coaching and I just wander around the gym, I'm not going to get the best return. But if I have somebody that's on my team that's, pushing me, and an accountability buddy that meets me at the gym every time, and somebody that,
makes you do the squats. You got to do squats.
Yeah. Yeah. It makes you do that. Makes you do those
The
2 or
deadlifts.
3 extra reps that you wouldn't do
That's right.
without them there.
Yeah.
I think that's really a big portion of it, right? You don't no professional athlete makes it
That's
to
right.
that high level of performance without some help, right? So that when it comes to the decision, like even for me and my family, like, do I need a financial advisor? Not because they know more than me. It's because I need somebody there that's gonna coach me. It's gonna say like, hey, maybe don't make that decision,
Right.
or hey, have you tried maybe saving a little bit more than you're doing right now? Just those little things pay off hugely, when it comes time for retirement. I think I'll look back and say 36-year-old John was a smart guy for getting some help when I'm 65.
Absolutely, man. That's awesome. I love what you said. These high performer athletes, business professionals, they're getting coaching. If you don't expand your knowledge or at least get someone there to coach you along that path to grow, it's going to limit your capability in retirement to have a great retirement or even enjoy life more now. So I think I think you nailed it on that one. But John, it's been fun, man. It's been awesome. I know we were getting our material together and we knew we'd have tons to talk about here. So hopefully it's been all useful, one that obviously we're passionate about. But I just want to ask everybody if they could go to iTunes and write a review, share the link. That is super helpful to help us get this podcast out to all pilots and just get the message out to help a little bit. We just want to help more people, serve more people. So give us a review, feedback, give us a rating, and then share the link. That would be super helpful if you can do that. And you can reach me at charlie@leadingedgeplanning.com. You can reach John at leadingedgeplanning.com, JON at leadingedgeplanning.com. So
John without an H, you got
John, JON at leadingedgeplanning.com. So give us a call or email, and we'd love to hear from you. And John, thanks for joining us today, man. It was a blast. Appreciate it.
Yeah, always fun, Charlie. Thanks for having me.
Thank you for listening to the Pilot Money Guys podcast. It has been our pleasure to share some information with you today. Give us a call to discuss absolutely any investment question you may have. Click on the subscribe button below to be notified when new episodes become available. Visit leadingedgeplanning.com to learn more. Take care.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for decisions based on such information, and it should not be relied on as such.